Picture your phone buzzing at 6 in the morning with a headline you never thought you'd read in your lifetime. The United States government has missed a payment on its own debt. Not a rumor, not a think tank warning, not a politician's talking point on cable news, but an actual, confirmed, first-in-history failure to pay. Before you've even had your coffee, futures markets on the other side of the planet are already in free fall. Currency traders in Tokyo and London are refusing to touch dollars. And somewhere in Washington, a Treasury official is staring at a screen trying to figure out which bills get paid and which ones don't. This is the kind of scenario that used to live only in economics textbooks and worst-case war game simulations. But with the national debt now sitting above $39 trillion, with the government paying out roughly $1 trillion a year just in interest, more than it spends on the entire military, and with the debt ceiling already raised once to over $41 trillion in the summer of 2025, this scenario has stopped being purely hypothetical. It has become something economists, credit agencies, and central bankers actually model and plan for. So let's walk through what would really happen, hour by hour, month by month, if the country that anchors the entire global financial system suddenly couldn't pay what it owes. Start with the person who has absolutely nothing to do with Washington politics and everything to do with the outcome. Call her Elena, 39 years old, a physical therapist in Denver who has spent the last decade quietly building a retirement account, paying down a mortgage she refinanced 2 years ago, and saving for her daughter's college fund. She's never read a Treasury auction result in her life. She doesn't know what a bid-to-cover ratio is. But on the morning the default hits the news, she opens her retirement app the way she does every payday and sees a number that makes her stomach drop. Global markets have opened in chaos. Stock index futures are down double digits before trading even begins in New York. This isn't an exaggeration for dramatic effect. It's roughly in line with what the White House's own Council of Economic Advisors projected years ago when they modeled a protracted default scenario, estimating a stock market decline approaching 45% if the standoff dragged on. Moody's Analytics ran similar numbers and put the potential hit to household wealth from a resulting sell-off at around $10 trillion. Elena doesn't know those numbers. She just knows her retirement balance looks like it did 5 years ago, and she has no idea when or if it's coming back. To understand why one missed payment can trigger something this violent, you have to understand what Treasury securities actually are to the rest of the financial world. They aren't just a government IOU sitting in some vault. They are the foundation stone. Banks hold them as collateral. Money market funds hold them as their safest asset. Pension funds around the world hold them because regulations often require a risk-free asset. And for over 2 centuries, U.S. Treasuries have been the textbook definition of risk-free because the government has never, not once in the modern era, failed to make a scheduled payment. That perfect record is precisely why the whole system is built on the assumption that it will continue. Pull that one card out, and everything stacked on top of it starts to wobble. This is also why the credit rating agencies have already been sounding alarms for years without a full default ever happening. Standard & Poor's stripped the U.S. of its top rating back in 2011 after a bruising debt ceiling standoff. Fitch followed in August 2023, citing what it called fiscal deterioration and a rising debt burden. And in May of 2025, Moody's, the last of the big 3 holdouts, finally downgraded the United States too, ending more than 100 years of a perfect AAA rating that had survived the Great Depression, 2 world wars, and the 2008 financial crisis. None of those 3 downgrades were an actual default. They were warnings. A real default would be the thing those warnings were warning about. Back to the morning of the announcement. Within the first few hours, the panic isn't really about the dollar amount that got missed. It's about what the missed payment implies. If the world's largest, most powerful economy can't make good on an obligation it has always honored, every assumption built on top of that trust needs to be re-examined immediately. And financial markets hate re-examining assumptions in real time. Traders start selling first and asking questions later. Credit default swaps, essentially insurance contracts that pay out if a borrower fails to pay, spike to levels nobody has seen because suddenly insuring against a U.S. default isn't theoretical anymore. Overnight lending between banks, the plumbing that keeps the entire financial system liquid day to day, starts to seize up because nobody wants to lend against collateral whose value just became uncertain. This is not unlike what nearly happened during the 2008 crisis, except the crisis was triggered by mortgage-backed securities losing their assumed safety. This time, the asset in question is the one that mortgage-backed securities, corporate bonds, and virtually every other financial instrument are priced relative to. Within days, the effects stop being abstract numbers on a trading terminal and start showing up in people's daily lives. Elena calls her mortgage broker because she'd been thinking about refinancing again to pull some equity out for her daughter's tuition, and she's told that rates have jumped by more than a full percentage point in under a week. Auto loan rates climb. Credit card interest, which was already sitting well above 20% for a lot of Americans, ticks even higher. Small business owners who were planning to take out a loan to expand find that banks have suddenly gotten far more cautious, tightening lending standards because nobody knows how deep or how long this crisis will run. Elena's clinic, which had planned to hire 2 more therapists this year, puts that plan on indefinite hold. Her own hours don't get cut immediately, but her manager mentions, almost offhandedly, that leadership has frozen all raises until there's more clarity. This is the part that rarely gets covered in headlines. A default doesn't just hurt Wall Street. It moves through the real economy the same way rising interest rates always do, just faster and with more panic attached. Companies delay expansion. Consumers, watching their retirement accounts shrink and hearing words like crisis and unprecedented on every news channel, pull back on spending. Restaurants see fewer reservations. Retailers see fewer big-ticket purchases. Manufacturers see order books shrink as businesses downstream get nervous. Economists have a name for this cascading pullback in confidence, and it tends to show up in every serious debt ceiling analysis ever published, whether from the Treasury Department, the Council on Foreign Relations, or the Committee for a Responsible Federal Budget, all of which have repeatedly warned that even the threat of default, let alone an actual one, tends to freeze credit markets and dent both business and consumer confidence almost immediately. Now widen the lens beyond Elena's kitchen table and look at what's happening on the other side of the planet, because this is where the story stops being a purely American problem. Foreign governments and central banks are enormous holders of U.S. debt. As of the most recent data, Japan alone holds well over $1 trillion in treasuries, making it the largest single foreign holder, with the United Kingdom close behind at around $900 billion. China's holdings, by contrast, have been sliding for years, down from a peak above $1.3 trillion back in 2013 to a figure that's now been cut by more than a third, part of a broader and very deliberate strategy some analysts call de-dollarization, where countries diversify away from dollar-denominated assets and, notably, buy more physical gold instead. Central banks around the world, led in recent years by China, Poland, India, and others, have been stacking gold at a pace not seen in decades. A trend that was already building before any default scenario, driven by exactly the kind of concern a real default would supercharge overnight. In a genuine default scenario, that slow, multi-year drift away from treasuries would almost certainly accelerate into something closer to a stampede, at least in the short term, as institutions scramble to reduce exposure to an asset that just proved it isn't as safe as advertised. That selling pressure, combined with a collapse in confidence, sends the dollar itself into a volatile spiral. Remember that the dollar is the world's reserve currency, meaning it's the currency most global trade and most countries' foreign reserves are denominated in, still representing more than half of global reserves, even after years of gradual erosion from a high closer to 70% at the turn of the millennium. When confidence in the dollar wavers, the ripple effects touch nearly every country on Earth, particularly ones that import oil, food, or manufactured goods priced in dollars. For Americans, a sharply weaker or wildly volatile dollar means imported goods, everything from electronics to clothing to a huge share of groceries, gets more expensive almost overnight, adding a fresh wave of inflation on top of an economy that's already reeling from frozen credit and falling asset prices. It's a brutal 1-2 punch, stagnation and rising prices arriving at the same time, the exact combination economists dread most because there's no single tool that fixes both at once. This is usually the point in the story where people ask why the Federal Reserve doesn't just step in and fix everything. And the Fed does step in, but its options in this specific scenario are more limited than most people assume. The Federal Reserve can flood the banking system with liquidity, it can act as a lender of last resort to keep banks from collapsing, and it can coordinate with other major central banks, as it has during past crises, to keep global dollar funding markets from freezing entirely. What it cannot do is directly fix the underlying problem, which is a political and fiscal failure to pay a legal obligation. The Fed doesn't set fiscal policy, it doesn't decide how much the government borrows or spends, and it can't simply declare the default didn't happen. During prior close calls in 2011 and again in 2023, this exact tension played out publicly, with Treasury officials warning that the Fed's tools, while powerful, were never designed to substitute for Congress actually raising or suspending the debt ceiling in time. In a real default, the Fed becomes the emergency room doctor treating symptoms while Congress is the only one who can actually cure the disease. Meanwhile, inside the government itself, a strange kind of triage begins. The Treasury Department has to decide in real time which obligations get paid first when there isn't enough cash on hand to pay everyone. Social security checks, military salaries, interest to bondholders, payments to federal contractors, Medicare reimbursements, they all compete for a shrinking pool of available cash. There's fierce debate among economists and former Treasury officials about whether the government even has the legal and operational ability to prioritize payments this way, a strategy sometimes referred to as payment prioritization. and whether trying to do so would even be logistically possible given how Treasury's payment systems are built. What's not in dispute is that whichever choices get made, someone doesn't get paid on time. And for that person, whether it's a retired veteran waiting on a benefit check or a small government contractor waiting on an invoice, the abstract concept of a technical default becomes a very concrete, very personal cash flow crisis. It's worth sitting with the 2011 episode for a moment longer, because it's the closest real-world dress rehearsal anyone has for what a full default might look like, even though it never actually got there. In the summer of 2011, Congress and the White House spent weeks locked in a standoff over raising the debt ceiling, and the country came within days of missing payments before a last-minute deal was reached. Standard & Poor's downgraded the U.S. credit rating anyway, just days after the deal was signed, arguing that the political process itself had revealed something troubling about the country's ability to manage its finances. The stock market didn't wait around for a philosophical debate about whether the downgrade was fair. The S&P 500 dropped more than 6% in a single trading day, one of the sharper one-day declines in years. And yet, within about 6 months, the market had not only recovered, it had moved to new highs, a pattern that is repeated in miniature nearly every time the debt ceiling drama has flared up since. Fitch's downgrade in August 2023 followed a similar script, a modest, immediate market dip, a somewhat larger slide over the following weeks as investors digested what the downgrade actually meant for future borrowing costs, and then again, a fairly quick return to growth. Moody's downgrade in May of 2025, arriving after markets had already priced in years of warnings, barely moved the needle at all in the way the earlier ones did, which some analysts read as reassuring and others read as a sign that markets have simply become numb to warnings that keep not quite turning into the real thing. That pattern, warning after warning that never quite tips into catastrophe, is exactly why so many people assume a full-blown default could never actually happen. That Washington will always find a way to pull back from the edge at the last possible moment the way it always has before. Maybe that's true. But it's worth remembering that every single one of those past episodes required an active decision by elected officials to resolve the standoff before the deadline, not some automatic safety mechanism built into the system. There is no law of physics that guarantees a deal always gets done in time. There's only a track record, and track records, however long, are not the same thing as guarantees. The debt ceiling itself was raised to just over $41 trillion in the middle of 2025, buying the country time, with most projections suggesting the next real fight over the limit won't come until sometime in 2027. That gap matters, because it means the next high-stakes standoff isn't some distant, abstract future event. It's sitting on the calendar, and the underlying math that makes each fight scarier than the last, a debt load north of $39 trillion, interest costs pushing past $1 trillion a year, a structural deficit that shows no sign of shrinking, isn't going away in the meantime. If anything, every year that passes without addressing the underlying deficit makes the next standoff a little more dangerous than the last one, because the numbers involved keep getting larger and the margin for error keeps getting smaller. There's another thread worth pulling on here, because it explains why the rest of the world isn't just a passive bystander waiting to see what Washington does. It's an active participant quietly hedging its bets in the background. For decades, foreign governments soaked up an enormous share of U.S. debt almost automatically, in part because there wasn't really a serious alternative, and in part because it was simply the safest, most liquid asset on the planet. That dynamic has been shifting, slowly but unmistakably, for more than a decade now. China's Treasury holdings have fallen by well over a third from their peak, a decline driven partly by trade tensions and sanctions risk, and partly by a deliberate, strategic push to reduce dependence on dollar-denominated assets, including by promoting its own currency for more international trade and by buying meaningfully more gold nearly every single month. China isn't alone. Central banks in Poland, India, and a growing list of other countries have been accumulating gold at a pace not seen in generations, treating it as a form of insurance against exactly the kind of scenario this whole story is describing. A moment when the dollar's reliability suddenly looks less certain than it did the day before. None of this means the dollar's dominance is about to collapse overnight. It still anchors more than half of global reserves, and there's no obvious replacement waiting in the wings capable of absorbing that role quickly. But a real default wouldn't be happening in a vacuum. It would be landing on top of a world that has already spent years quietly building small, gradual hedges against exactly this possibility, which means the reaction, when it came, would likely be faster and more severe than it would have been 20 years ago, precisely because the exits have already been partially built. Let's go back to Elena for a moment, because her story is really the story of tens of millions of ordinary people living through this. A few weeks in, the initial shock starts to give way to a grinding, exhausting uncertainty. She hasn't lost her job. Her mortgage payment hasn't changed because that's a fixed rate loan from years earlier, but everything new costs more. The refinance she wanted is off the table because rates are punishing. Her daughter's 529 college account has taken a hit right along with the rest of the market. Her clinic's owner mentions in a staff meeting that patient volume is down because people are skipping elective physical therapy sessions to save money. A small, unglamorous, very real example of the consumer pullback that economists warn about in the abstract. Elena starts doing the thing so many people do during financial uncertainty. She checks her accounts obsessively. She cuts a vacation she'd planned. She starts bringing lunch to work instead of buying it. Multiply her by tens of millions of households simultaneously making the same small defensive choices, and you get exactly the kind of broad-based slowdown in consumer spending that tips an already fragile economy into recession. Now here's where it's worth pausing the doom spiral for a second, because history actually offers some useful, if imperfect, guidance. The United States has never fully defaulted in the modern era, but it has come extremely close twice in the last 15 years, in 2011 and again in 2023. And both times, a deal got done before an actual missed payment occurred. Both times, markets reacted sharply but not catastrophically once resolution seemed likely. And both times, the economy avoided the very worst outcomes precisely because Washington, at the 11th hour, did what it needed to do. That pattern matters because it tells you two things. First, brinkmanship alone, even without an actual default, is genuinely damaging, since both the 2011 and 2023 standoffs led directly to credit rating downgrades and real measurable market volatility, even though payments were ultimately made on time. Second, the system has, so far, always found a way to step back from the edge, which is either reassuring or terrifying, depending on how much faith you have in future Congresses, to keep doing that as the debt keeps climbing and the political fights keep getting more bitter. But suppose, in this scenario, that resolution doesn't come quickly. Suppose the standoff drags on for weeks rather than days. This is where the difference between a brief technical default and a prolonged one becomes critical, because most serious economic models draw a sharp line between the two. A default lasting only a few days, quickly resolved once Congress acts, would still rattle markets and likely trigger another credit downgrade. But the broader economy would probably absorb the shock and recover within months, similar in spirit to how markets bounced back reasonably quickly after both the 2011 and 2023 downgrades, once the immediate crisis passed. A default that drags on for weeks or months is an entirely different animal. That's the scenario where the White House's own economic modeling projected the deepest stock market losses, the sharpest spike in unemployment, and the kind of self-reinforcing downward spiral where falling asset prices cause more spending cuts, which cause more layoffs, which cause more spending cuts, in a loop that becomes genuinely difficult to break without extraordinary intervention. There's also a slower, quieter version of this damage that persists no matter how quickly the immediate crisis gets resolved, and it's arguably the most important part of the whole story. Even after Congress strikes a deal, even after payments resume, even after the stock market claws back a chunk of its losses, the interest rate the government has to pay on new debt tends to stay elevated because investors who just watched a default happen, even briefly, demand a higher rate to compensate for the risk they now know is real. This is sometimes called a permanent risk premium, and it's expensive in a way that's easy to underestimate. Consider that the government is already paying out roughly $1 trillion a year in interest, a figure that recently overtook the entire defense budget for the first time in modern memory, according to Congressional Budget Office projections. Every fraction of a percentage point added to the borrowing cost compounds across tens of trillions of dollars of outstanding debt, meaning even a modest, permanent increase in what investors demand to hold treasuries could add tens or hundreds of billions of dollars a year to the interest bill indefinitely, money that then has to come from somewhere else in the federal budget, whether that's higher taxes, cuts to other programs, or even more borrowing to cover the gap. So let's bring this back down to ground level one more time, because all of this, the credit default swaps, the foreign reserve diversification, the payment prioritization debates, ultimately exists to explain why Elena's retirement account dropped, why her mortgage broker quoted her a worse rate, why her clinic froze hiring, and why her grocery bill crept higher even though nothing about groceries themselves changed. The connection between a missed bond payment in Washington and a physical therapist's grocery bill in Denver isn't some contrived movie plot. It's the literal documented transmission mechanism that economists at the Treasury, the Federal Reserve, the Council on Foreign Relations, and virtually every major bank on Wall Street have described in painstaking detail every single time this scenario has come close to happening. Confidence is not an abstract concept in finance. It is the actual mechanism that keeps money moving through the system efficiently. Remove it, even temporarily, and everything downstream gets more expensive, more uncertain, and slower to recover. Eventually, in almost every version of this scenario, the crisis does resolve. Congress reaches an agreement, whether that's raising the debt ceiling, restructuring some near-term obligations, or some combination of emergency measures. The Treasury resumes normal payments. The Federal Reserve, having spent weeks or months providing liquidity and coordinating with other central banks, starts to step back as private markets regain their footing. Stock markets, which almost always overshoot to the downside during acute panics, begin recovering, often faster than anyone expects, much the way they did after both the 2011 and 2023 downgrades, when initial sharp drops gave way to strong rebounds within a year. Elena watches her retirement account slowly climb back. Not all the way, not immediately, but enough that the immediate panic fades into a kind of background anxiety rather than an acute crisis. Businesses cautiously start hiring again. Credit markets thaw. Life, in the way it tends to, goes back to something resembling normal. But something has changed, and it's not something you can easily see on a balance sheet. The country that spent over 200 years building a reputation as the single safest place in the world to park your money has shown, definitively, that the unthinkable is not actually impossible. Every foreign central bank that was already quietly diversifying into gold or other currencies now has a very concrete reason to keep doing it, and to do it faster. Every credit rating agency that had already been warning about fiscal deterioration now has actual evidence to point to instead of a hypothetical. Every future debt ceiling negotiation happens under the shadow of a precedent that didn't exist before. The knowledge that brinkmanship can, in fact, tip over into an actual missed payment, not just a scary headline. Trust, once broken, doesn't necessarily stay broken forever, but it takes far longer to rebuild than it took to shatter, and in the meantime, the cost of that broken trust shows up every single day in the interest rate the government pays, the mortgage rate Lena's neighbors get quoted, and the pace at which the rest of the world quietly, steadily looks for alternatives to depending so heavily on a single country's promise to pay its bills. It's also worth pointing out that this entire scenario would be unfolding against a backdrop that was already getting more strained with or without a default. Net interest costs have been climbing faster than almost any other line item in the federal budget for years now, and the Congressional Budget Office projects that trajectory doesn't level off anytime soon, with interest payments expected to roughly double over the next decade, even under relatively calm, non-crisis conditions. Some projections show interest costs eventually overtaking every other category of federal spending, except Social Security, within a couple of decades if nothing changes, meaning the country would be spending more to service debt from the past than to invest in anything about its future. A default doesn't create that underlying trend. It accelerates it, front-loading years of higher borrowing costs into a matter of weeks or months, and turning a slow, grinding fiscal problem into an acute, headline-grabbing crisis almost overnight. That's really the core tension running underneath this entire story. The difference between a problem that's been building gradually for years, easy to ignore day to day because nothing dramatic ever seems to happen, and the sudden, sharp moment when that gradual problem finally forces itself onto everyone's screen at once. Whether that's a physical therapist in Denver checking her retirement balance, a central banker in Tokyo deciding whether to keep holding treasuries, or a member of Congress staring down a deadline that, this time, might not have a last-minute save waiting at the end of it. Zoom all the way back out, past Elena, past the Treasury Department, past the trading floors in Tokyo and London, and what you're left with is a lesson that applies far beyond government debt. Financial systems, at their core, run on trust more than they run on any specific number on a balance sheet. The United States has been able to borrow more than almost any nation in human history at remarkably low rates, precisely because, for over 2 centuries, it never gave the world a reason to doubt that it would pay what it owed. That reputation is arguably the single most valuable, least visible asset the country holds, worth more in practical terms than any oil reserve, gold stockpile, or piece of military hardware. Because it's the thing that lets the government borrow cheaply enough to fund everything else. A default, whether brief or prolonged, whether caused by political dysfunction, a technical glitch, or a genuine inability to pay, spends down that asset in a way that's very hard to earn back. Which is why, whenever you hear economists, Treasury officials, or Federal Reserve chairs use words like catastrophic or unprecedented when they talk about even the possibility of default, they're not exaggerating for effect. They're describing, with as much precision as anyone can muster about a scenario that has genuinely never fully played out before, exactly what happens when the safest bet in the history of global finance stops being safe, even for a moment, and the rest of the world has to relearn, in real time, that nothing is guaranteed forever, no matter how many centuries of history seem to say otherwise.